Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. Now it is that time of year again, ladies and gentlemen, where we're going to talk to Mark about his predictions in the new year. But before we do that, Mark, let's kind of go back to 2019, right? So what happened? How did you fare with your predictions last year?
Well, I'm glad you asked, Uncle Matt. Always good to be back with you. I'm proud to say once again, we batted 100% on all of our predictions for 2019. We are now 100% every year that we've started our predictions dating back. I believe this will be probably our sixth or seventh year doing predictions. I'm pretty proud of that track record. Of course, last year I had someone send me an email ridiculing me that these weren't predictions, to which I, of course, had to debate with him and correct him that they were predictions. And you know, the irony was that he said they're not predictions, they're actually facts of life. And I thought that was kind of ironic, if you remember that whole conversation.
I do. That kind of backfired on him just a smidge, didn't it?
Yes. So, 2019 was, not only did we fare really well on our annual predictions that we put out that you can find at investwithclarity.com, but we also had our best year for our clients since 2013, where clients were up, in the neighborhood of 25 to 35+% last year, depending on their portfolio, because they did not listen to all of these predictions. In other words, the dichotomy is, while these are my predictions, I don't follow my predictions. Now, isn't that ironic?
Elaborate.
Well, basically, I think people, when you look at the biases about investing that investors have, including the addiction to prediction and the biases that tap into that addiction to prediction, predictions end up being nothing more than the chaff from the wheat. And I don't know about you, but I prefer the wheat over the chaff. And so investing with clarity is about investing in great businesses over time, allowing volatility to take advantage of buying more of those great businesses on sale. And I'm sure I remember I talked about this at the beginning of 2019. I had tweeted out on Christmas Eve that we probably had seen the bottom of this correction. It just hit 20%. It was a half a day of trading, of course. And we don't normally predict market bottoms, but it was just ridiculous. It was the talk about recession and all the noise and the pundits babbling about chaff told me that it was an extremely aggressive time to be investing. Of course, the numbers came out later that investors moved out of equity ETFs at that time and put a vast amount of money into bond funds. And I think they will find that that was a regrettable move.
2020 now, brother. What are you predicting for this year?
Well, first of all, as you know, predictions are nothing more than predictions, which means there is a possibility that I will be wrong. The good news is that you can go back to all my predictions because they're written down on our blog at investwithclarity.com, and you can see what I wrote and see if I was right or not and verify that I went 10 for 10. Mm-hmm. So let me start with the first most important prediction, which is what we usually start out with every year. You ready?
I am.
Most predictions on where the S&P 500 will end in 2020, just like 2019, will be wrong, with the potential consequences of investors piling in on overpriced assets and missing out on great companies on sale. How do you like that?
It's pretty darn sound. And
it's a prediction, though, right? Well, I mean, because there's no guarantees that that's going to happen.
That is by definition a prediction.
Thank you. You want me to go to number two?
The first one was very clear. I will ask for clarification.
Me on that first one.
No,
you don't want to take me to task.
No, but as always, I'm going to try to find one way to get you tripped up. All right, number two.
I appreciate the enthusiasm. Number two, company stock prices, as well as, quote, the stock market, will move up and down irrationally. December of 18, as usual. Remember, you don't invest in the stock market, though. You invest in businesses purchased through a market. So stocks over short periods of time move irrationally up or down all the time, Matt. And people allow their biases, which, of course, we've just finished doing several podcasts on biases, right?
Yeah.
Important podcasts for people to listen to so they can tap into and understand why these predictions are so important as it pertains to their investing. Because quite frankly, there's a lot of investors missing out on this bull market. A lot.
Well, and not only that, but if you have not listened to, I think we did, 2 or 3 podcasts on the actual proven ways that people are wildly behaviorally incorrect about how they interact with their stocks, their bonds, their plans, their everything, finances in general. You have to go back and listen to that. That was flipping gold and really sets the stage for how you can really look at everything that you're hearing in the mainstream media. That is the 3 Ps. What are those Ps again? Postulation,
prognostication, postulation, and speculation.
See, there's a P in the third one. But yeah, so, and Mark has spent lots of time talking about that. So since people are so irrational, your second prediction makes a lot of sense, because if people are, then the market will respond by the people's response to responding. I'm just going to keep saying the word responding. How's that?
Well, this is our first podcast for 2020, full disclosure to all of our listeners. And so, I think responding is the right word to use in our first podcast.
Yeah. Maybe that's the key word.
I just thought I'd help you.
Yeah, thanks. You totally rescued me there, dude. We should have like a little bell every time we say the word responding. It should ding. All right, so that was number 2, dude. Let's go to number 3.
Number 3, and this is a age-old strategery that people like to use, which has allowed them to fail miserably, as the Dalbar studies report. Many investors will continue to attempt to time the market, not time in a business, but time the market, right? And it will be wrong. As a record, you ready for this? 135 billion came out of stock-based funds and ETFs and went into cash and bonds, thus missing one of the best years for stocks since the Great Recession. Boom.
That was in 19? That much money left in 19?
Yes.
Holy Moses.
Yeah. Some of us going to start chasing it pretty soon here. Remember, bull markets die on euphoria. Yeah. We haven't seen euphoria in this market since the financial crisis of 2009. Mm-hmm. Now, many people say that the bull market started in 2009 when it bottomed. Actually, our researchers, our team state that the bull market actually didn't start until after the S&P 500 reached its old highs, which was actually in 2013.
Interesting. Okay. Mm-hmm. Now, you talk about people timing the market, right? And just for fun, because I love you as a podcaster,
Thank you.
I signed up for Google Alerts on a couple of specific investments that I have. And every time I get an alert, it just makes me giggle. Because I'm like, okay, it sounds like they have like this great mathematic reason why something's going to happen, but it's really just a load of hooey.
Well, correct. And we talk about this as it pertains to some of the biases, and particularly when it comes to media biases. We've talked on the program in the past before about a company that we have owned that has not performed well, and it had a negative impact on portfolios in 17 and 18. But as we pounded the table and told our clients we're investors in long-term in businesses, and we gave the analogy of Warren Buffett in 1998 and 1999, significantly underperforming the S&P. I mean, the S&P was up like 86%, and he was down like 33%. But from March of 2000 through like October of 18, The S&P was up 100%. He was up 400%. And I can't stress enough the power of clarity when it comes to investing and the ability to understand what you own and why you own it. And of course, the big thing is, which is public information, which I should disclose. This is not a solicitation or a recommendation to buy this stock, but Zest is embroiled in a $2 billion lawsuit with Walmart. And while we don't know what the outcome of that will be, we certainly understand what we own and why we own it. And that could have a dramatic impact on the portfolio. Well, if you talk to investors, and frankly, if you talk to advisors about companies like that, or any other company that goes through a massive downward spiral before they turn it all around, i.e. Apple in the 80s, right? When it became a penny stock, almost went broke, and now it has a market cap over $1 trillion. There are tons of examples of businesses that have turned things around and have become great investments. And so people get these Google alerts. They have no idea what the biases are from the people who are sending it. They have no idea how it necessarily impacts their asset allocation, their portfolio. And most importantly, they're looking at numbers and they're getting a feel for something as opposed to looking at the facts and sticking to buy discipline, sell discipline, and asset allocation strategy. How's that for a mouthful?
That was beautiful. That was almost poetic.
Wow, thank you. Well, I haven't done a podcast for a little while, so maybe I'm just a little fired up today.
I've never seen you fired up before, Mark. All right, I think we're at number 4, right?
Yeah, number 4, which gets to the next, which is a great segue, by the way, to number 4. Focusing on short-term or historical performance will distract investors from making intelligent long-term investment decisions and focusing on their financial plan. Remember, when you invest in the stock market, it's a market where you buy and sell businesses. You're investing in actual specific businesses. Therefore, you should invest like a business owner. Business owners do not take a short-term viewpoint to running their business. They take a long-term viewpoint to their business. I had a business owner in my office yesterday, ironically, pitching an idea he wants me to consider investing in a company he started, right? And I was telling him how we manage money at Nepsis. And he said, he didn't even know what an SMA was, separately managed account. So I had explained to him all the benefits. And I had said, you probably think the stock market is a risk. It's a gamble because you don't know what you own and why you own it. He said, you're exactly right. That's why I don't invest in the stock market. I invest in my own companies. Well, duh. That's the whole premise of investing with clarity, because he knows what he owns and why he owns it. And so when you get to that point, the idea of focusing on short-term returns is less important. And what's more important is the analysis of, is it a great time for me to buy more of that business on sale?
That was beautiful, magnificent, but...
Uh-oh. Are you actually going to finally question me?
No, I'm actually going to support what you're going to say. Because he said, I invest in my businesses.
Right.
So what you're talking about is teaching people how to invest in when they do buy stock in a company, they do own part of that business. So he just totally reinforced everything you freaking said.
That's my whole point.
Damn it. One of these days, dude, I'm going to get you. Number 5.
My whole point. All right. Speaking of which, some investors will allow their emotions to get the best of them and make investment decisions emotionally as opposed to fundamentally. Not only did Zest have problems in 17 and 18, but in 18 in particular, the Chinese stocks, a lot of Chinese stocks got absolutely decimated as well. And negatively affected portfolios. And we said, that's a bunch of phooey. That's what Chuck says. I'm going to use steal Chuck's word and use phooey. And said, it is an unbelievable opportunity to buy blue chip names in China. Was I right? Well, let me give you some examples. As of January 1st, 2019, TCOM is up 40.13%. Since then, 40.13%. Alibaba up 64.98%. Let's see, JD.com is up a paltry 91.83%. Bison 20.64, Tencent 20.13, IQ 60.19. Are you picking up what I'm laying down?
I am.
Investing in great businesses over time and not allowing the myopic focus of what has caused your portfolio not to make money by the end of a calendar year is massive. I don't know if people understand this, but the stock market does not move on a calendar basis. Investments do not perform on a calendar basis. I've never quite understood the process of taking a look at my portfolio at the end of the year to see if I've made money or not, because the fact of the matter is you don't make or lose money until you sell an investment. That's a fact.
Mm-hmm.
So people look at their statement at the end of the year or at the end of the month or at the end of the quarter. Oh, I made this amount of money this month. Or, oh, geez, I lost this amount of money. You don't make or lose anything until you sell it. And our clients have enjoyed tremendous returns in those investments. By the way, it's starting really in October and aggressively in November, December of 18 and January of 19, we bought a lot of these investments on sale, a lot. And, clients who own these stocks are up these kind of percentages in their portfolio because they stick to the process.
I think in 2020, we need to go back and do another podcast on process and fundamentals. All right, because I think it's been a little while since we went through that, and it also gives everybody who's listening to this one a better idea on or if they have not subscribed, to subscribe so that they can get those. Because I loved the Fundamentals podcast. I thought it was super fun, and I also thought it was really neat to once again talk about your process, because the process itself isn't necessarily evolving, but you're evolving. So therefore, the way you communicate and talk about the process has definitely evolved over time. All right, so that was number 5, right? Are we on number 6 yet? All right.
Number 6, stock market volatility will continue to scare investors and in turn create great buying opportunities. Like always, yes, we did, as I said before, take advantage of the massive pullback in volatility in 18 and 19. And it should be noted, as we have written in our quarterly update coming out probably later this week, in 2020, don't be surprised if you see a lot of volatility. Now, a lot of the experts are saying they don't think you'll see a 5, 6, 7%, anything greater than that pullback or correction this year. However, on average, you can see a 14% correction from peak to trough on any given year, and it happens just about every year. But people are saying it's going to be less volatile. I think it's possible, but the problem with that is you are in an election year. And not only are you in an election year, you're in an election year where people are pretty dang fired up on both sides of the spectrum. And I will be surprised if, as we get closer to the election and we don't understand who's possibly going to win the election, some greater volatility. But regardless of that, it will create a tremendous opportunity to buy those companies on sale.
Because that's what we do. Because volatility does breed opportunity. Absolutely. All right. How many predictions, by the way, are we going over
10.
today?
What? Go quick, Danielle.
10? Oh my gosh. Well, we're on number 7, so we're doing well.
I mean, I can certainly speed it up and not,
No, we got time, dude. We're totally good. Yeah, keep going. All right, number 7.
All right, number 7. Many investors will continue to focus on inaccurate portfolio comparisons with benchmarks, focusing on fees and short-term performance versus the investment process, a symptom of poor investment clarity. Pretty straightforward.
Well, it's always amazed me how many financial services professionals don't have a published process. They don't have a investment policy sort of statement. They don't have any of those things. And so if you don't know what your financial services professional is shooting for, then any of those benchmarks don't matter. And do you know what your benchmark needs to be? We had a podcast on that, didn't we?
Yeah, we don't use benchmarks.
Yeah.
The benchmark
wrong
people
word.
should be concerned about is, am I on track to have the kind of financial future I want to have?
Right. So I'm sorry, I used the wrong word there, because part of investing with clarity is knowing what outcome you're looking for. Is that a better way to say it?
Correct.
Okay.
Look, people try to do comparisons all the time. The fact of the matter is you're comparing apples to oranges. I mean, I can't tell you how many people have tried to compare our portfolio performance to the S&P 500, and they've been told 1,000 times, we don't invest in just U.S. stocks. If you want to compare your portfolio to the S&P 500, then compare it to the U.S. stocks we own. Don't compare it to the entire portfolio, because in an appropriate asset allocation strategy, you must own U.S., international, and emerging markets, as well as potentially fixed income, real estate, and what other assets that may be appropriate for your portfolio.
Well, and because of your process, you help people gain clarity, not only in what they own and why they own it, but where they want to go. And really, you have that deep conversation with them.
Correct. And tie it all together.
Yeah, tie it all together.
It's about the process with an ultimate strategy.
And that's the pretty bow that you get with Nepsis. All right, dude, let's go to number 8.
Number 8, investors will continue to be over-diversified in their portfolio and not properly asset allocated, leaving their portfolios inefficient. As I just alluded to about global investing, many investors own too many investments, and they are, from a statistical standpoint, frankly, over diversified. Their portfolios are watered down. And not only that, they are not allocated properly to take advantage of the volatility and buy stuff on sale, when you don't want every single thing in your portfolio working well at the same time. You don't. Because you want to buy stuff on sale. Let me say that one more time. You don't want every position in your portfolio doing well at the same time. You want to have some losers in there, because it's the losers that allow you to buy more on sale to create an opportunity for you to gain potential alpha down the road in that company. Just as I said about the China names in 2019. And I can give example after example of companies that we own, that we have owned, that have gone from super high prices to super low prices, back up to super high prices. And that's where your sell discipline comes in and makes a significant difference in the process of accomplishing your long-term goals.
Mark, I was having coffee with a friend of mine who actually happens to be an advisor. I asked him how many different mutual funds he has in his clients' portfolios, and he looked at me like I was crazy. And I'm like, look, that I really like this guy, Mark, because I talk about you, just because I think you're freaking smart. And so I said, shouldn't you know that? Like, how do you have quarterly meetings or semi-annual meetings with your clients? And he's like, well, they get the prospectus. It's like, oh my God.
Wow.
Yeah, that hurt. That stung.
And you wonder why investors are running to low-cost ETFs, because they, in the absence of value, thus becomes price.
Yeah, dude, what value is this guy offering? And of course, that's where my conversation went after that. And he was pleasantly surprised at how he needed to really truly look at how he's going to value things, because he just acquired a new business. So therefore, that's something that he's focusing on. All right. Well, I just thought I'd pass that on to you, because I knew that you'd be,
but not uncommon, unfortunately.
Yeah, I know. All right, next up, what do we got?
Investors will continue to follow the headlines instead of the bottom line when making investment decisions. Just look at all of the 2019 headlines that predicted doom and recession. And did it happen? No. While the S&P 500 and the Dow are dancing around new all-time highs as we speak.
People got to stay away from the clickbait, man.
They sure do. There's no doubt about it.
All right, before we wrap up today, let's go back through the predictions that we've done so far and then wrap it up.
Wait, can I just give you one more?
Well, yeah, I figured you had one more, but I can you go back through the first ones first, and then we'll finish on the last one?
Oh, gotcha. Yeah. Sorry. Okay. So I'll just give you a snippet of it all night. I won't read them all totally, but most predictions on where the S&P will end in 2020 will be wrong, with potential consequences and investors missing out on great companies on sale. Number 2, stock prices, as well as, quote, the stock market will move up and down irrationally as usual. Number 3, many investors will continue to attempt to time the market and be wrong. Number 4, focusing on short-term and historical performance will distract investors from making intelligent long-term decisions. Number 5, investors will allow their emotions to get the best of them and make investment decisions emotionally as opposed to fundamentally. Number 6, stock market volatility will continue to scare investors and in turn create great buying opportunities. Number 7, investors will continue to focus on inaccurate portfolio comparisons with benchmarks, focusing on fees and short-term performance versus investment process. Process. As I always like to say, Uncle Matt, it is process before progress. Number 8, investors will continue to be over-diversified and not properly asset allocated, leaving their portfolios inefficient. Number 9, investors will continue to focus on headlines instead of the bottom line, just as they did in 19 in predicting the doom and recession.
All right, number 10.
Number 10, investors will continue to have unrealistic time horizons for their investments, focusing more on short-term pain versus long-term gain. We call that the tragedy of a short-term thinker.
Now,
and there you have it.
Well, so what would happen in the world if any of these 10 predictions didn't come true? I mean, wouldn't the world actually be a better place? I'm being all on you now, dude.
Yes, correct. But then it would be harder to make money.
That was a damn good answer, man.
We like when people are emotional, because the clients who pay us to provide value, we take advantage of the emotional predisposition of people.
Yeah.
That's what investing with clarity is about, taking advantage of opportunity.
Well, once again, it's always a pleasure to hear your predictions. I don't think we're going to be singing Kumbaya around the fire in 2020 on just about anything, let alone your 10 predictions. And it's going to be super fun because we're going to dive back into fundamentals. We're going to dive back into your process. We're going to talk a little bit more about some of the other things that make Nepsis truly unique and different. So, Mark, thanks for the show again today, man.
You got it, boss. We'll talk to you soon.
All right. If you have not subscribed to the podcast, make sure you click that subscribe now button below. And you need to share this podcast with other people who have money in the markets, or people who own businesses and don't put money into the markets because they truly don't understand the great opportunities that are there. It's super easy. All you have to do is click that share button. So for everybody at Nepsis and Mark Pearson, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.